For over 10 years, I've been preoccupied by the impact of investment costs and how it erodes the rate of return of a portfolio. I was inspired by John Bogle, who was the founder of the Vanguard family of funds. You see, when we think in terms of investment costs, we oftentimes will hear them in terms such as 1.5% or 0.25% or 200 basis points. Let's keep in mind that there's 100 basis points in 1%. Well, when you consider that the average expense of an equity mutual fund portfolio is 4.1%, yeah, that seems like a fair amount, but when we apply that percentage to a $2 million equity mutual fund, all of a sudden we realize that $82,000 is quietly sneaking out the back door year in and year out. So it's real important for the investor, whether you're investing money on your own and managing your own portfolio, or you've engaged an advisor to help you in that process, it's real important that you understand not only what the costs are, but how they're employed within the management of your portfolio. Let's take a look at what those costs are of 4.1%. According to Morningstar, the research firm out of Chicago, they estimate that the average expense ratio of an equity mutual fund for last year, 2011, was 1.3%. According to the Wharton Business School, they estimate that the trading costs, the buying and selling of stock within a mutual fund, it's the commissions that are attached to those transactions. And particularly with small companies, every time they buy a significant block of stock, they'll push the stock price up, or selling, they'll drive that price down. All of that is a component of the trading costs, which is 0.8%. Cash drag. Vanguard estimates that the cash drag is 0.4%. Cash drag is that amount of money that's supposed to be invested in stocks but is actually sitting in cash, not earning a rate of return that's available for stock redemptions at the end of the day, or for active managers, perhaps an opportunity to buy something in the future. That erodes the rate of return by 0.4%. The tax costs, Vanguard conservatively estimates that at 1.6%. The Lipper Institute estimates that cost could be as high as 2.5%. But let's use Vanguard's number. If they're right, when we add up the total level of costs, we find that the average equity portfolio incurs 4.1%. That's the high hurdle that the investments have to capture just to get to square one at the end of the year. Our clients believe what we believe, that you can only manage what you know and what you're aware of. Not all costs are bad, but there's no way to compress these costs down like an institutional investment manager does unless you know what those costs are. I'd encourage you, think through and look at the costs that are impacting your portfolios.